For 5 years, Brex was the it card. If you were a founder, if you had a startup, you had a Brex card. It wasn't just a piece of plastic, it was a status symbol that said, "We are the future." The future got expensive. What of the most telling deal in fintech isn't a massive IPO, but a scale that once values a once $12 billion unicorn at a 60% discount. What if the buyer isn't a tech giant, but a credit card company best known for Samuel L. Jackson asking, "What's in your wallet?" And what if this $5.15 billion deal isn't just about buying a company, but that admitting in 2026 you can disrupt the banks without becoming a bank? Welcome to Business Insights Daily. I'm your host, Sishank. Today, we're talking about the end of an era for Silicon Valley fintech. Capital One agreed to purchase corporate finance startup Brex for $5.15 billion in cash and stock. Now, $5 billion is a huge exit. For most founders, it's a dream. But for Brex, it's a reality check. This price represents a 60% discount from Brex's peak valuation of $12.3 billion in late 2021. It's the clearest signal yet that growth at all costs days with zero interest rates are gone. The market has repriced risk, and the companies that built their model on cheap money and endless venture capital are now finding safety in the arms of traditional banks. But the market didn't exactly throw a parade for Capital One. Capital One shares fell 7.6% Friday after the news broke. Why? Because the bank also reported weaker than expected fourth quarter earnings. Adjusted earnings came in at $3.86 per share, missing estimates of $4.14. Expenses are rising. The efficiency ratio, a key measure of how much it costs to make a dollar, worsened. And so investors looked at this and said, wait, their costs are already growing up, and now you want to spend $5 billion on a money losing startup? It's a classic conflict. Short term pain and earnings miss versus long term bet, buying Brex. For a founder's perspective, the Brex story is incredible. Two young founders, Enrique Dubugras and Pedro Franceschi, realized that startups couldn't get credit cards because they had no credit history. They had millions in the bank from VC funding, but FICO scores of zero. So, Brex invented a new model, underwriting based on cash in the bank, not credit history. It exploded. It became the fastest growing B2B card in history. But then interest rates rose. Venture capital dried up, startups stopped raising money, and suddenly Brex's core customer base was struggling. Capital One is betting that it can take Brex's technology, his slick software, the expense management, and the travel booking, and plug it into its massive, stable balance sheet. It's the bank fintech convergence we've been waiting for. The cool infrastructure meets a boring but profitable vault. Why would a bank like Capital One want Brex? Two words: business spend. Capital One is huge in consumer cards, credit cards for you and me. They're underweight in corporate payments. Brex gives them instant access to thousands of high growth companies like DoorDash, Robinhood, and the next generation of giants. It also gives them software. Banks are terrible at building software. Brex is credited. By buying Brex, Capital One isn't just buying customers, they're buying an operating system for business finance. But let's get back to that number, 60% discount. This is a warning shot for every other unicorn out there. Brex, one of the best brands in fintech, is selling for half off. What is everyone else worth? It suggests a wave of consolidation is coming. The standalone fintechs that can't reach profitability will be scooped up by incumbents. The disruptors are becoming departments inside disrupted. So, next time you swipe a corporate card, take a look at the logo. It might say Brex, but the money behind it, that's coming from a bank that's been around a lot longer than the latest tech boom. Thank you for listening to Business Insights Daily. I'm your host, Shank, and we'll see you next time.